On the surface, this looks like a stock that failed, a plant-based meat company, an overcrowded category, a fad that faded, case closed. Except that's not what happened. In 2019, Beyond Meat had the best IPO on a major US exchange in more than a decade. Shares rose 163% on day one. Bill Gates was in, Leonardo DiCaprio was in, McDonald's signed on. At its peak, the company was worth over $10 billion, bigger than Harley-Davidson, bigger than Xerox. Today the stock trades for less than $1. That isn't the interesting part. The interesting part is this. By the time the public saw the collapse, the real collapse had already happened years earlier. The business was breaking while the stock was still climbing, and almost nobody was looking at the right thing. This is the story of how that actually happened and why the final crash was just the symptom. To understand why Beyond Meat collapsed, you have to understand why it should have worked. In 2019, the world was lining up for something different. Climate anxiety was rising, health narratives were shifting, millennials were buying differently, and for the first time, a startup had figured out how to make a plant-based patty that bled, seared, and tasted close enough to real beef that mainstream grocery stores would carry it. Founder Ethan Brown had spent a decade building it, and on May 2, 2019, he rang the opening bell at NASDAQ. By the end of that first day, Beyond Meat was worth nearly $4 billion. Within months, it was worth over $10. The stock hit $234 a share. Analysts compared it to the early days of a tech company. Goldman Sachs called it healthy momentum. Forbes called it a disruptor. For a moment, Beyond Meat looked like it was rewriting the food industry. Revenue grew 170% in a single year before the IPO. Restaurant partnerships multiplied. Kentucky Fried Chicken tested Beyond Fried Chicken. Pizza Hut tested Beyond Sausage. Starbucks added Beyond breakfast sandwiches in China. Grocery shelves expanded. International deals stacked up. The story wrote itself. Meat was the past. Plant-based was the future, and Beyond was the company that had cracked it first. Then in 2021 came the biggest deal of all. McDonald's, the largest fast food chain on earth, announced a global partnership, a 3-year deal, a co-developed patty, a new product called the McPlant. For Beyond Meat shareholders, this was the confirmation they'd been waiting for. If McDonald's was in, the category was real. The mainstream breakthrough had arrived. Except the mainstream breakthrough wasn't a breakthrough at all. It was a test, and the test was already failing. Inside McDonald's franchises, the numbers told a different story. A BTI analyst surveyed locations in the Dallas-Fort Worth test market. The target was 40 to 60 McPlants sold per day. The reality was closer to 13. In San Francisco, sales came in at the low end of projections. In some rural test locations, franchises were selling only a handful per day. Sales were so bad that PETA reportedly bought McPlants in bulk to keep the numbers from cratering. By August 2022, the test was over. McDonald's quietly discontinued the McPlant in the United States, and McDonald's wasn't alone. Dunkin' dropped Beyond. Hardee's dropped Beyond. A&W dropped Beyond. Every major food service test, one after another, ended with no follow-up order. The public narrative was that plant-based meat was conquering fast food. The actual data was that Americans had tried it and walked away. Once the McDonald's narrative cracked, every other weakness came into the light. The first problem was price. A Beyond Burger cost nearly twice as much as the beef it was trying to replace. During 2019's flush economy, that was tolerable. When inflation hit in 2022 and 2023, it wasn't. Grocery sales started falling. Nielsen reported plant-based meat sales dropped 2.3% in 2024. The Good Food Institute reported sales down another 10% in 2025. Retailers started pulling shelf space. The second problem was culture. Beyond Meat became politically charged. Critics on the right attacked it as woke food. Health influencers attacked it as ultra-processed. Consumers who had once bought it to feel good started associating it with lab chemicals and long ingredient lists. The third problem was competition. Impossible Foods moved faster, landed the Burger King Whopper, and caught up on product quality. Private label plant-based products from Kroger, Costco, and European supermarkets undercut Beyond on price. Tyson and Cargill, traditional meat giants, launched their own plant-based lines using existing distribution. And then, in September 2022, something strange happened. Beyond Meat's chief operating officer, Doug Ramsey, a 30-year Tyson veteran hired to professionalize operations, was arrested after a college football game in Arkansas. According to the police report, he punched through the back windshield of another driver's car and bit the man's nose, tearing the flesh. He was charged with terroristic threatening and third-degree battery. Weeks later, he was gone. The incident had nothing to do with the business model, but it became a symbol of a company that appeared to be unraveling on every level at once. But here's what most people miss. None of them were the real collapse. The real collapse was a business model that had never actually worked. Even at the height of the hype, Beyond Meat had never turned a profit. Not in 2019, not in 2020, not in 2021. Not once. The company raised hundreds of millions of dollars, built factories, hired aggressively, expanded internationally, and the losses widened every year. The IPO money ran out. The partnerships that were supposed to fund growth were the ones discontinuing products. The grocery channel, supposed to be the stable base, started shrinking. Margins were consistently negative. By late 2024, Beyond Meat was carrying roughly $1.2 billion in debt against a business losing money on every unit it sold. The company was no longer scaling into profitability. It was scaling into deeper pressure. The headlines talked about stock volatility. The real story was written in the filings. Years earlier, it had been structurally broken since the year it went public. Then in October 2025, something no one predicted happened. For 6 years, hedge funds had been shorting Beyond Meat, betting the stock would fall. By late 2025, short interest in the company had climbed to levels rarely seen in any major listed stock. By some measures, more than half of the available shares had been sold short. Between October 16 and October 21, 2025, Beyond Meat's stock went from 52 cents to over $3.60, a rally of more than 596% in 5 trading days. Overnight, a collapsing plant-based meat company became the hottest meme stock on the market. Social media called it the new GameStop. For a moment, it looked like Beyond Meat had been saved. It hadn't. Within weeks, the rally collapsed. Q4 earnings came in worse than expected. The company issued weak guidance. Shareholders who'd been diluted by the 2024 debt-for-equity deal, where Beyond issued hundreds of millions of new shares to restructure over $1 billion in convertible notes. By early 2026, it was under 60 cents again. The meme rally wasn't a recovery. It was the loudest exit door in the room. So what really killed Beyond Meat? It wasn't the McPlant. It wasn't the nose-biting COO. It was something quieter than all of them. Beyond Meat was built on a single bet that the American consumer would pay a premium forever for a product that tasted almost, but not quite as good as the thing they already loved. For a few years, during peak climate optimism and peak growth capital, that bet worked. The IPO was the moment where hype and reality briefly overlapped. Everything after that was the gap between them widening. The celebrity backing didn't fix the margins. The McDonald's deal didn't change the math. The meme rally didn't rebuild the business. Every headline, every new product was a story about the stock, not the company. As of 2026, Beyond Meat is still technically operating. It has cash. It has shelf space. It has a brand most consumers still recognize, but it's running against a shrinking category on a diluted share base. With debt it can't outgrow. Could it turn around? Theoretically, yes. Practically, it would need a version of itself that never actually existed, one that could make money on a single burger. The real lesson isn't about plant-based meat. It's about how a company can win every external battle, the PR battle, the celebrity battle, the cultural moment, and still lose the only one that mattered, the one happening quietly, inside the filings, the whole time. Beyond Meat's collapse wasn't the story of a failed product. It was the story of a company that was celebrated for everything except the one thing that mattered, whether it could actually make money. The IPO of the decade, the celebrities, the partnerships, the meme rally, all of it was noise on top of a business that never worked. You've watched Triumphs and Troubles. Subscribe to the channel for true business stories and comment, which company should we cover next?